program is the active center.
You look at the data in our research today, and the story of this guy, Craig, immediately jumps out.
Oh, yeah, that one is really striking.
Right. He buys a primary residence, holds it for like less than 7 years, and watches the asset value literally quintuple.
It's crazy.
It is.
Oh.
And that explosive price appreciation kind of becomes the bedrock for his entire portfolio.
Yeah.
But, relying purely on market appreciation is essentially just speculation.
Definitely.
So, okay, let's unpack this. Because the real engine of real estate wealth isn't just hoping the broader market goes up.
No, not at all.
It's coupling that appreciation with deliberate income generation. And really look under the hood at the actual financial mechanics driving these returns.
Right. So you can figure out how to map the right asset class to your own lifestyle and capital. What's fascinating here is why that specific two-pronged approach operates as such a powerful economic shock absorber. When you leverage debt to acquire an income-producing asset, the tenant's cash flow is actively servicing the debt.
Right, which hedges against inflation.
Exactly, and it covers the operational drag. You are effectively letting the asset pay for its own capitalization while the underlying equity expands.
Wow, yeah. And that really brings us to the physical property game, right? Like residential versus commercial. I like to think of residential as buying a single apple tree.
That's a great analogy.
Yeah, while commercial is like acquiring the entire orchard. With the single tree, your risk is just so heavily concentrated.
Oh, absolutely. One bad season and you're in trouble.
Right. It isn't just about a bad tenant.
Yeah.
A single localized vacancy or, say, an unexpected capital expenditure like a sudden roof replacement can completely wipe out your yield for the year.
Yeah, the operational leverage in residential is incredibly tight. But when you scale up to an orchard, say, a multi-tenant retail complex or a large office space, you are fundamentally altering the financial mechanics.
Because of the economies of scale.
Yes, but it's not just about collecting more rent checks to dilute the risk of a vacancy. In commercial real estate, the asset's value is directly tied to its net operating income, or NOI.
So if you increase efficiency, the value goes up.
You got it. If you improve operational efficiency across 50 units, you force the valuation of the entire property up based on prevailing cap rates.
That makes sense.
You basically manufacture appreciation completely independent of whatever the broader housing market is doing.
Right, I get that. But, buying the orchard requires massive initial liquidity.
It really does. You
are trading that concentration risk for a much steeper barrier to entry and, frankly, highly complex debt structures.
Which is why capital-constrained investors, or people who just want to avoid operational drag entirely, shift into alternative vehicles, things that decouple the asset from the management burden.
Here's where it gets really interesting. Because if you want pure passive yield, you just buy into a REIT.
Right. Our real estate investment trust.
Yeah, you get fractional ownership and mandate-driven dividend distribution without ever having to deal with a property manager. But looking at the sources, that brings up a glaring contrast with the other non-landlord strategy.
You mean flipping?
Yeah, flipping. If a REIT is pure capital allocation, isn't flipping basically just a grueling, highly taxed construction job masquerading as an investment?
That is a super common perspective, yeah.
Right. You are hunting distressed debt, managing contractors, and sinking your own sweat equity into the margins.
Well, if we connect this to the bigger picture, it's really a mistake to write flipping off as just manual labor. It's actually a high-velocity arbitrage play.
Wait, arbitrage?
Yeah, think about it. A REIT investor trades control for liquidity and passive yield. A flipper does the exact opposite.
Oh, because they're identifying severe pricing inefficiencies.
Exactly. They find these distressed assets and force appreciation far faster than the natural market cycle. They aren't waiting 7 years for organic growth like Craig did.
Right. They are manufacturing equity in 7 months through targeted capital expenditures.
Exactly.
So what does this all mean? Ultimately, whether you are utilizing the operational scale of commercial properties, the high-velocity arbitrage of flipping, or the passive dividend engine of a REIT, you have to align the underlying mechanism with your specific risk appetite.
And you have to remember that the core risk threading all of these physical strategies together is the liquidity constraint.
Right. Unloading physical property isn't like just dumping equities from a brokerage app.
Not at all. It requires significant lead time, transaction costs, and buyer financing. You are locking capital into an inherently illiquid vehicle.
Which exposes you to macro market volatility during the hold period.
Mm.
Which means building genuine financial security requires structuring your portfolio around the lifestyle and liquidity you actually need, rather than just chasing the highest theoretical yield on paper.
This raises an important question, though.
What's that?
Well, if a flipper's entire margin relies on the rapid velocity of capital, forcing appreciation and exiting quickly, but physical real estate is notoriously illiquid.
Yeah.
What happens to that manufactured equity when a sudden macro shock makes buyers vanish overnight? Craig could wait out a 7-year cycle, but if you are highly leveraged for a 7-week turnaround, where does that sudden freeze leave your portfolio?
Hello, and thanks for listening. This is David Sepp and the Active Center team. For years, our mission has been to foster a community around engagement, health, and conversation. If you value what we do, please consider supporting us. We've started a GoFundMe to cover our production and operational costs, including those pesky social media fees. Your contribution, big or small, helps us keep going. Thank you.